Hi everyone, and welcome to the webinar about the Intelligent Investor Select Value Share Fund. And the webinar title is A Proven Approach to Global Investing. And that's because this ETF that we're going to talk about, that is managed by the Intelligent Investor team, is 80% international stocks and 20% Aussie stocks. And one of the reasons why we do these webinars is that we have them linked to the secondary offers that run 4 times a year. So each of our 4 funds gets a chance to actually be put forward in these different offers. I will just make this a bit bigger so you can see what I'm talking about. And obviously there's the important information there. So everything we discuss in the webinar is general advice only. Remember that past performance doesn't always equal future performance, and always read the product disclosure statements as well. Okay, so if I take you through, just quickly talk about the secondary offer. And the secondary offers are put there so that if you want to join or get part of the Intelligent Investor ETFs, in particular the Select Value Share Fund, you can actually be part of this offer, and it runs from the 17th of February, which was just the Monday, and it's going to run until the 28th. And so what basically happens and what it means is that you can get a minimum of $2,500. That's the minimum investment in the fund, and there's no brokerage fees paid, and there's actually no spread. So you get the net asset value on the close of the 28th of Feb. So you don't pay the buy-sell spread, which is 1 cent either side. So it does trade in the ASX. The ticker code is IISV, so you can buy it on there as well. But this is an opportunity you can apply online. There's a little QR code there too, but it's offer.intelligentinvestor.com.au/IISV. And just to knock some questions on the head, it doesn't dilute the holdings. It has a liquidity provider that will actually create more units or even remove units if needed. So it doesn't actually trade at a discount to the NAV, the net asset value. Basically, it just means that we can create it as needed. You can always transfer your holdings that you take up through this offer. You can actually transfer them to your share brokerage account. And that's just by providing your HIN, your holder identification number, during the application process. And we'll touch on these again in terms of some of the features, particularly on how it works. But what I'll do now is I'll introduce you to Nathan Bell and Nick Cummings, and they're the actual analysts that sit behind this fund and manage it. So I'll just bring them in and we can get started. Hi, Nathan, and hi, Nick.
Morning, Tom. Morning, Nick. Morning, everyone.
Morning, guys.
And just remember that you can always ask questions as we go. We've got heaps of questions that have been submitted before the webinar, and we've got Mitchell Datson, who's part of our portfolio team, who can also answer questions in case we miss some of them. So go ahead.
Thanks, Tom. So morning, everyone. As always with the International Fund, we've got a lot of questions, so I'll do my best to get through the slides as fast as possible, although I always say that and fail. But the 2 main messages from today are that I'll talk about why we created this fund in the first place, so that newer investors can understand the fund and why we launched it and how it works. But the key message today really is that the indexes are stretched now. So theoretically, at least, that makes them the easiest to beat in future. And when you go through some of the stocks, and Nick's going to help me out with that, you'll see, and this is the second main message, is that you just don't have to pay the premiums for some of the best businesses in the world listed abroad as what you do to the greatest businesses listed in Australia, which are trading at twice the multiples. And that's really the huge advantage. So I've probably never been more confident that we're going to beat the index from here. It's really just a matter of by how much. But maybe that confidence is misplaced. But I think you'll agree when you see the sort of stocks we're buying and seeing where the best Aussie stocks are trading at the moment. Like, I'll just tell a quick story, but I remember when I went to upgrade stocks like CSL and Cochlear, back when I started as Intelligent Investor back in sort of 2006, 2007. I remember it was a really, really big deal to upgrade those stocks to buy at 17 times earnings. And it's just laughable in the current environment. CBA trades at 27 with 2% growth, and the tech stocks are trading at anywhere from 50 to 150 times earnings. So, and some of them are growing rapidly and they're great businesses, but it's just amazing how things can change in what is a fairly short period. So I just, in lieu of time, I just want to skip through some of the process slides, and you can, when you get a copy of the slides, you can read those for yourselves. And a lot of you are already familiar with them anyway, but I just thought I'd talk about why I really want to launch this fund and the genesis for the fund. And throughout history, I've just seen over and over again that the funds with the most flexibility are the funds that achieve the best returns. And to me, the best flexibility was to be able to buy a core or a rump of the best businesses overseas, the compounders that trade at much more attractive valuations than those great compounders in Australia trade at. But I also wanted a sleeve to be able to put in some of our best, particularly smaller cap ideas in Australia. So smaller caps like MA Financial and RPM Global that we think over time can become much bigger and billion-dollar mid-cap stocks. And so far, that's worked perfectly. In fact, it couldn't have really worked any better unless we owned NVIDIA, probably. So that was really the genesis of the fund. And then we're very lucky to get Nick with his international experience as well. And he's having more of an impact on the fund with some of his unique ideas as well as time goes on. So everything's going really well. And even though we're only 2 years in, I think the theory for the fund has already proved itself. And I'm going to go through a bit more detail on that in a second. We also wanted a bit of room to have some value stocks. Ideally, we just want to own stocks that I said from the get-go that we just wanted stocks that were essentially buy once and then hold. And so they're just one decision stocks. Now, obviously, in reality, the world changes, businesses change, and you've got to make changes to the portfolio, even if it's just for portfolio sizing or management reasons. But there's a couple of value stocks in there, so that they're not the great compounders necessarily, but other than Mineral Resources, which ironic is one of the Australian stocks we included. We've got another value stock there I'll talk about in a second. It's doubled and still only trades at 13 times earnings. And so, not every stock has been a winner in the fund, but the most pleasing thing is that we've done it differently. We haven't just owned the Magnificent Seven. Our proportion of the portfolio invested in those is pretty small, certainly much, much lower than the index. And I'll talk about some of the names in a second. And that last 2 points is that most of the stocks we'll ever buy will be listed in the US because you can actually get global exposure through those exchanges, and it reduces the risk as well, because if you've got, say, we've got a very small holding in a company called AFIA, which is a Brazilian stock, and that's listed on the NASDAQ, and at least then the company still has to report on US standards and comply with all US regulations. So that's a real benefit. And then the last point there is you won't see us investing much in Asia. There's probably a case to buy China at the moment, or buy an ETF and get some broad exposure for a bunch of different reasons, but we haven't done that. But you won't see a lot of exposure to Asia. I've just found in my experience it's just too risky, too difficult, and we just don't need to do it, especially when you've got the whole world to pick stocks from. There's plenty of opportunities. So the performance has been great, but I actually think that even though we're doing 8% per annum, we've only been going for 2 years, better than the index, I think the stock picking has been much better than that. We use the benchmark is the ASX, and I've talked about that in the past. The reason we did that is because it's the best performing benchmark in the world over the last 100 years, and we wanted to set the bar as high as possible for the performance fee. And also, I like the idea that if you're going to invest money overseas, then you should have to beat the benchmark at home. So it's just, in a sense, like an opportunity cost or an opportunity hurdle that you have to beat. So that's why we chose that. And if the banks were trading at anywhere near fair value, we wouldn't be doing 8% per annum above the index. We'd be doing something like 13. And I think that would be far more reflective of the value we've added in the fund in the 2 years than what it actually shows there. The thing I'm most pleased about, though, is we just haven't owned the Magnificent Seven. We've had a really broad array of stocks that we've got our returns from. So it's very different from the US index or the MSCI, very different, obviously, from an Australian fund. And obviously our strike rate has been very high because we've been in a very good environment and our stock picking has been excellent. So I just thought I'd very quickly, there's some of our biggest returners. So you can see there's a little bit of representation from some of the familiar names like Amazon and Google, which are in the Magnificent Seven. But you've also got MA Financial, which reported this morning. So I'm not sure how that's traded yet. RPM Global, which is an absolute minnow. It's quite funny. Amazon, $1 trillion, or Google, $1 trillion businesses there next to RPM Global, which is like $500 or $600 million business. But then you've got MasterCard and Visa, which are a core of our fund, and we'll talk about those. But if it wasn't for essentially one risk that's out there, I'd love to have 10% each of those in the portfolio. They're just astounding businesses. And then there's Cairn up the top, which is an Irish home builder, and that's the example of the value play, and that's more than doubled and trades on 13 times earnings still. So it's just a really broad array of stocks, and that's where we've got our returns from. But these stocks are far from done, and actually some of them look very cheap, surprisingly, given how stretched the indexes are, and are amazingly cheap considering what you're paying for some of the equivalent Australian stocks. So just a couple of other things. This portfolio or fund is more diversified than what our other funds have been. We typically run with 20 to 25 stocks in our other funds. I tend to find once you get to that 20, 21st, 22nd stock, it's really not a very good idea, or you're basically just trimming a stock that you've had a much bigger position in that's on its way out. So it really makes you focus on your best businesses, but at the same time, it also makes sure that no one stock is going to mess up your returns. And we've actually run with about 35 stocks, and to start with, we've really struggled to keep it to 35. But I think that's actually the perfect number, and we've had an opportunity to potentially increase that in the PDS. But 30 stocks at an average of 3.5%. Spread amongst the sort of businesses that I've already described is you're not really going to get any less risk than that in an equity portfolio. Again, we're buying US listed stocks at times, but their actual underlying business exposure is not just to the US. At the moment, we've hedged the currency, our US dollar currency. So that hasn't been a big gain for us like it has been with a lot of other funds. So there's a tiny bit of currency benefit in our returns, but not much. And our currency tends to follow the iron ore price, which is reasonably strong at the moment. But if the Aussie dollar snapped back, that wouldn't be a deficit for the fund at the moment. And I think this last point is really, again, I've repeated myself, but this is probably the most important message of today's presentation, is that you're actually able to buy the Magnificent Seven from anywhere from about 25 to 35 times earnings, even a little bit less. Yet to buy the equivalent stocks in Australia, they're trading at 50 to 100 times earnings. And that's an enormous difference. And I'd say some of those businesses that are easily Australia's best businesses, at least for the moment, you're going to have to own them for a long time to at least justify those price to earnings ratios. And they're inferior businesses in the most part compared to the stocks we own. So there's two big differences. Not only are they riskier businesses, but they trade at twice the multiple, if not more. So just a couple of points. I've already said this, but all the major indexes in the Western world are stretched at the moment. That's Australia and the US. But it's really come down just a couple of sectors. In Australia, it's really just the tech and banking sector, and everything else has been left in the dust, as you can see from the returns on our Australian funds at the moment. But also, again, I've just listed some. They're not necessarily directly rivals, these stocks, but they're either similar stocks or similar types of stocks. And, I've named some of the stocks that we own compared to, their sister stocks in Australia, and the multiples are just chalk and cheese. I won't go through them here, but, I think I've made the point. So I'm going to get Nick to run through 3 stocks in a moment, and then we'll take some questions. But I just wanted to provide an update on Fairfax. This is a good example of the sort of stock that's, again, not a Magnificent Seven stock. It's not a tech stock. It's essentially the Berkshire Hathaway of Canada. It's our biggest holding in the fund, which is the main reason I want to mention it. It's almost doubled since we bought it, but it's up 5-fold since COVID. And even though it's called the Berkshire Hathaway of Canada, the guy who founded it, Prem Watsa, he's also known as the Warren Buffett of Canada. And for a long time, this company's been around for decades. If you go way back to the sort of 90s, the price to book ratio got crazy, and then the share price came back down to reality. It was nothing to do with the business, and it sort of recovered and did really well, particularly through the GFC. Prem was really well prepared, and it went gangbusters. But he then thought that another GFC was coming, like many people did in around 2014 or 2015. So he took out a lot of hedges across. And so bear in mind, this is an insurance business, and with a big equity portfolio. So what he did was he decided to hedge the portfolios again, like he did during the GFC, but instead this time the market just kept going up, and this was really painful for the earnings of the business. And so the stock was really in purgatory for a number of years. Prem lost his reputation as the Warren Buffett of Canada, and the stock just languished and basically just got forgotten. And that's why it got down to about $400 a share during COVID. But it was exceptionally cheap. And by the time we launched the fund, it was about $1,200. Now it's $2,100, I think. But you'd think, if it's gone up 5 times, well, you think the multiple must be 40 times or 35 or 50 times earnings. And yet it's not. It's trading around 9 times earnings, 1 times book value, and return on equity at the moment, according to our software, is around 20%. Now, that will move around a little bit due to the nature of the business, but that hardly screams fair value to me. So I think this stock is in a period of a decade long, at least, re-rating as people come back to the stock. So it's a very safe business. It's expertly run. It's a founder-owner. Founder-owners have been a little bit tarnished. Founder managers have recently with what's gone on in Australia with MinRes and WiseTech, but it's still what I think is one of the last free kicks in the market, is to back those sort of guys in a diversified portfolio. Obviously, it doesn't mean every stock's going to work, and you don't want to just make a bet on the jockey all the time. It's the quality of the business that matters most. But again, it's just another good example of how a well-run business survives decades and invests for the long term, and that's why the company's still going strong after 30 or more years. The other issue with the business that I think is keeping some people away is there's been a big benefit to the company from interest rates going up. And there was a feeling that, there's going to be some sort of problem with the economy and interest rates are just going to go way back down and crush the earnings again. But I just don't think that's going to happen. And I think people are actually missing the value that's being created in the underlying business, whether it's exposure to India through its fund and the fees that come from that, or owns, I think, a quarter of or more of one of the best airports in India, and it just has some wonderful assets that I think are being overlooked as people focus on macro things. And you really got to be careful investing not to let those macroeconomic concerns override the fundamentals of the business. So that's Fairfax. So to me, that's just a really good example of just not necessarily a familiar business that's exceptionally cheap and just a much higher quality and much cheaper business than you can buy in Australia. So with that, now to some more familiar names, and I'll hand it over to Nick.
Thanks, Nath. Yeah, so this is a company that most of you will know. You probably have one of their cards in your wallet, and it's a stock I've covered and followed for over a decade. It's still one of the highest quality and most resilient businesses we can find anywhere in the world. So it operates in a duopoly with MasterCard, which we also own. And essentially it takes a small clip of every time you tap your card, phone, or even services like Afterpay. And the beauty of this is merchants are pretty much locked in because there's 4.7 billion Visa cards outstanding. Merchants have to accept it. They also have to accept MasterCard. If they didn't, the consumer would walk next door and they'd lose their business. Another feature is credit risk. There's no loan losses and Visa takes no credit risk. And this is very different to a business like American Express, which also operates a payments rail. Visa also cleverly shifts the customer acquisition costs and customer servicing costs for things like replacement cards to the banks. So they don't have to pay any of these costs. That's borne by the banks. And essentially this just makes them very capital-light businesses, and each incremental time you tap your card or each incremental transaction really drops to the bottom line. So return on equity has been 50% for, I think, almost a decade. And operating margins are now over 65%, which is some of the best you can find anywhere in the world. And the good thing here is the opportunities that, or the growth that has driven the business over the last decade is still here. So the transition from cash to card is only about halfway done. We think the next sort of 50% will be driven by emerging economies, which are a bit behind countries like Australia. And then the other big opportunity is value-added services. So this is where Visa takes all their transaction data, so we're talking trillions of different transactions, and uses that data and repackages it and then sells it back to merchants and the banks through things like fraud detection and prevention products, and also loyalty offers or targeted promotions. And we think that really underpins sort of a mid-teens earnings per share growth profile, very similar to what Visa's achieved over the last decade. And we can buy the business today at around 24 times earnings looking out a year or two, because there's a bit of regulatory overhang. The Department of Justice in the US is trying to reduce debit card fees. This is only around, I think it's about 15 to 20% of Visa's business, but we think at most they can probably lose 2 to 3% of revenue, even if this if the Department of Justice was successful in proving that it's a monopoly. But we think that's Visa is growing at sort of double digits each year, so we think they can wear that. And essentially, we're buying a business around a market multiple that we think is much better than the overall market and more resilient than the overall market, with far better growth. So that looks quite attractive to us.
Maybe Visa should relist in Australia. It'll trade at 75 times earnings.
Yeah, that's right. Yeah, it's cheaper than CBA at the moment, or about the same multiple, which is kind of crazy.
Nick, can you just quickly explain what the difference is between MasterCard and Visa?
Yeah, so they're pretty similar businesses. The big difference is Visa is a bit more US-centric. So about 45% of the business comes from the US for Visa, and about a bit over 50% from the rest of the world. MasterCard, that split is about 30% from the US and about 70% from the rest of the world. And that's probably why MasterCard actually trades for a higher multiple. They have experienced high growth over the last few years. And they have also gone into that value-added service segment that I described prior. They're pushing there harder. So that's about 25% of their revenues. And for Visa, it's about 15 to 20%. So that's probably the big differences between the two.
Just had a question come through there that said, is there any maximum weighting of any one stock before we start selling? And the answer to that is that selling is an art, not a science, and we don't have any prescribed limits necessarily, other than I think the maximum we can own of any one stock is 15%. But in any of our funds, I don't think we've gone anywhere near that with any stocks. I think perhaps the only one was BHP in our Australian funds, but that was still just in line with the index. In terms of this fund, I think the most we've ever had is actually Fairfax at the moment, which is probably pushing towards 8%. But it really comes down to, and this is why you can't actually prescribe. It's first of all the risk of the stock. You don't want to make, your biggest positions want to be ones that you're feeling very safe about, either because they're just great quality business, but even they can change. You just want any potential loss to be manageable and make sure that you've got a position size that if something goes wrong, it's manageable, because it's often the risks you don't see coming. Like Mineral Resources, for example, where they've had 5 cyclones that's ruined a little bit of their road, which they need to go and patch up. So obviously we don't have to worry about that with Visa, but the regulatory crackdown might be tougher or something like that. So it's, to me, portfolio management is probably one of the things we don't really talk about, but it's probably the single most important decision in investing, because if you only invest a small amount in a company and it does really well, you don't really make much, but you put too much in a company that doesn't do well and can create a loss that can really mess with your head. And that's actually worse than the loss sometimes. If your willingness to make the right decisions and take the right risk in future is damaged from a bad situation with one stock that you got wrong, then that's way worse than the commission loss on the stock. But again, it's really quality that drives it. So MA Financial is probably one that I think it's getting towards 6% in this fund, but it's got higher in our other funds, and we've started taking profits, even though it looks like it's at the very start of a multi-year profit upgrade cycle after a long period of investing. So you're trying to walk this sort of tightrope between letting your returns compound, because once you start selling, you're creating tax events. And the key to great investing is to let your returns compound without, creating capital tax gains events along the way and having to pay tax and therefore disrupting the compounding. But at the same time, you're just trying to make sure that every risk is manageable in case something unexpected happens. So no specific limits, but I think it's probably pretty standard with any value investor. Depending on what type of fund, obviously it's different for small cap funds, for example, normally, not for some of my friends, but normally once you start getting above 6%, you would see a fund manager starting to take profits. Rightmove, Nick.
Yeah, so Rightmove's a pretty easy business for most Australians to understand. It's essentially the REA group of the UK. But unlike REA, it didn't start life as a classifieds business in the newspapers. It was actually started by 4 real estate agencies in 2000 as an online offering. And so they initially went to other real estate agencies and offered them to list their listings for free on the site. And then those real estate agencies drove eyeballs to the site. And after a few years, Rightmove was really the incumbent with the most traffic. And that remains the case today. So they have about 80% market share or audience eyeballs share out of all UK sort of property portals. And that's 6 times larger than their nearest competitor. And so if you're a vendor in the UK and you want to sell your home, you want to get them, the maximum price, you really insist that the real estate agency lists on Rightmove. That's what you want. And so real estate agents are pretty much locked in. One feature of the model that's a little bit different than REA2 is Rightmove operate a subscription service. So essentially real estate agencies pay about £1,500 per month on average to Rightmove to list their properties, whereas REA Group actually, the vendor pays. And so that makes REA Group's revenue a little bit more volatile with actual listing volumes, whereas Rightmove's is more resilient because it's sort of a subscription service. And as I said, vendors insist that real estate agencies post their listings on Rightmove, so they never churn. So the only time they really lose a customer is if the real estate agent actually leaves the business. So over the last, say, probably 5 years, this has been a steady grower. It's been growing at around, this is in terms of revenue growth, around single digits or high single digits. But we think that can actually accelerate to double digits in the next few years. There's a lot of low-hanging fruit here. So they're really early on in their mortgage originations business. So this is a move that REA actually made a decade ago when they partnered with NAB. They also bought Mortgage Choice. Rightmove has been really a residential listing service. So they've got all this data and obviously 80% of the entire UK market. And now they can use that audience and go into these other funnels, which we think can really accelerate growth. At sort of 21 times earnings, next year's earnings, we think this is a really attractive offer. REA actually tried to acquire the business about 6 months ago for a 20% premium to the current price. They tried to pay £8 a share, and I think the shares this morning were at about £6.50 pound. So there's a big value discrepancy there, and Rightmove's board knocked that offer back pretty quickly. So we think there's a lot of value on offer here, and REA have signalled that by launching an acquisition, and they can actually make another offer I think within 6 months, according to UK takeover law. So there's probably another month we'll find out what they're going to do there. So 21 times earnings. This looks very attractive, and we think we can sort of get a mid-teens return out of it.
The UK market generally has been pretty depressed compared to other markets, but I think there's also a new competitor that's probably worried a few people.
Yeah, there is. So the new competitors on the market, and they've been a competitor for about a decade, but the change was CoStar Group, which is a large US, mainly commercial listings service. They bought on the market, and they've launched, they've put a lot of marketing spend into the UK. So far, we haven't seen any eyeball share go from Rightmove. Zoopla, the second player, is now suffering a little bit. And this is typically what we've seen in most marketplace models. that once a new competitor comes in, it's the incumbent that stays, and the second competitor can be disrupted. And Rightmove have fought off competitive challenges before. Google tried to have a go in this market, I think, back in like 2009, 2011. REA actually tried back in 2006. And who was the other? You've had Purple Bricks. Zoopla was well funded a couple of years ago. Like they've fought them all off. So I'm not too worried about that competition. But that's probably why we can buy it a bit cheaper than some of the other good marketplace businesses around the world. I mean, REA Group, just for a comparison, trades at 60 times earnings. So it's a huge discrepancy there.
Haven't heard that name Purple Bricks for a long time. I remember that was was a huge commotion when that stock came out. It was like the next REA Group. CME Group, Nick.
Yeah, so CME Group, this is the world's largest derivatives exchange. And essentially, it allows traders to buy and sell futures or options on really massive markets. So think like US government bonds, treasuries, Fed funds rate, copper, oil, and even index options on, say, the S&P 500. And unlike a typical stock exchange, it doesn't have to convince companies to list on its exchange. So there's no companies listed here. And it doesn't suffer if one of those companies that was listed were to go private. It still benefits from the same network effects, though. So traders really want to do business with the exchange that's the largest because the market's the most efficient. So that just means simply that the bid-ask spread is tighter. And for traders in derivatives markets, this is a big deal because some of these markets can be quite opaque. And so you want the market with the most liquidity and the most volumes. And so that means that CME Group is actually really monopolies in most of their products. So it's a fantastic position to have, and it's really a fixed cost structure. So like Visa, as volumes grow, it really drops to the bottom line. I think the operating margins here are around 65 to 70% most years as well. So incredibly capital light. Another feature that we like is the management team. It's led by Terry Duffy. He's a CME veteran. I think he became executive chair in 2002, really pushed them to go digital, so off the trading floor. And he led several successful transformational acquisitions of the New York Mercantile Exchange and the Chicago Board of Trade. And he's also kept a very clean balance sheet. And so this is unlike a lot of other exchange groups, which typically run with a fair bit of debt. So this really puts CME Group in the box position if there was an attractive asset that came up for sale. Volumes here are volatile year to year, and that's to be expected. But over time, that we see they tend to rise. So the last decade, the volumes have risen at about 7% per annum, and CME have raised prices about 1% to 2% per annum on top. So all up, they've been able to grow net income at 12%. And we think that won't change over the next decade, although year to year will be volatile. In their main business, interest rates, their interest rate complex, volumes tend to follow government bond issuance. So the US is in really a structural deficit. And as those deficits rise and government bonds issuance continues to increase, CME's volumes should benefit. It's also really it's a bit of a hedge to CME Group. If markets are volatile, there tends to be a lot of trading activity, and CME Group tends to do well in those periods as well. We're buying the business because there's a potential new competitor that's been around for around 6 months now, and it's trying to take market share in the interest rate space. They've been pretty unsuccessful so far, and CME sort of fought them off. And 6 months ago, the stock was sort of down to, I think, $200. It's now back to $250 because I think the market's now starting to appreciate this. But we're still buying it for 23 times, and it's paying us a 5% dividend. And this is a stock that actually hasn't done a lot over the last sort of 5 to 7 years. So we think there can be a catch up because the earnings have done quite well over this period. And again, like Visa, we think this is a more resilient and better business than the average business you find on the market. And we're buying it for a below market multiple, with a growth profile that we think is above the market. So it looks pretty attractive.
I think one of the important things, although there can be some cyclical elements to some of these businesses, CME is somewhat opposite. It's more, if there was a bear market, for example, or something on in credit or interest rate markets, the increased activity helps provide some ballast to the portfolio, because that's actually good for the company, unlike most other businesses. And particularly you compare that to a typical Australian portfolio where over 50% of it is invested in highly cyclical resources, stocks and banks. This is very different. The key part of the analysis is all around the competitive moats surrounding these businesses. And it's not like there aren't any risks. There's risk to every business, but you own a portfolio of 20 to 30 of these and you're going to do well over time, especially when you're paying these sort of prices.
There's heaps of questions coming through, which is fantastic. And Mitchell is on the side there trying to answer them. Some in case that you, maybe if you're following us on YouTube or one of the streaming services, you may not see all the questions being answered. But Patrick asked a good one. Can a non-Australian resident invest in this fund? And Mitch has answered and said, there's no restriction for investors based on their geographical location. And it does trade on the ASX, remember, and under the ticker code of IISV, but you can go through this secondary offer. And I'll put the URL up for that too, if you want to get it directly from us, which ends on the 28th of Feb.
So that includes Tasmanians like me, Tom?
Unfortunately not. That's, yeah, of course, yep. There's a special consideration for people from the Great Land of Tassie.
I just want to make one last point on the slides, because I don't think this is particularly well understood, particularly by new investors who may not be familiar with ETFs. I think there's often confusion that they think our listed ETFs are listed investment companies or LICs. So Tom talked about at the start how our funds never trade at big discounts or premiums, because there's a market maker to make sure essentially the fund trades at net asset value. So that's essentially what you pay or receive depending on whether you're buying or selling units. But it's not the case where if you see that our funds aren't particularly liquid on any day, that doesn't have any reflection on the liquidity of the actual underlying fund. All that shows you is the demand and supply for the fund. And because we're a fairly small fund, you wouldn't expect a huge amount of liquidity in the units from day to day. But the actual liquidity of the fund itself, and obviously with the stocks we've talked about, they're giant stocks, so liquidity isn't an issue for this fund at all. But we do have to oblige very strict liquidity restrictions because under the ASX listing rules, and particularly with the Australian funds, they're very frustrating at times because we can't own a lot of smaller cap stocks that sometimes we'd like to. But at the same time, it does reduce risk, and that's really why they're there, because no one, I always get pressure from our investment committee and the board and management to make sure we're always highly liquid, because some of those people are ex-ASX executives, and no one in the industry wants to have any association with an illiquid fund. And obviously, that's just not even worth talking about with this fund. But I just want to explain the difference between the extremely high liquidity of our fund versus the low liquidity of the actual traded ETF itself. All right, I'm done, Tom. Fire away.
You're done? Excellent. Well, we've got so many questions here. Mitch has tackled some. I'm going to go to one which looks very interesting because it's definitely something a lot of people are talking about. And it's your friend and mine, President Donald Trump from the United States of America. Do you have any concerns that the Trump chaos might cause a major correction in world stock markets? Murray asks.
Well, the funny thing is most people don't want a correction in stock markets, whereas I'm desperate for one. The thing that people don't understand is, yes, there is a temporary bit of pain, but unusually since the GFC, we really haven't had a lot of great buying opportunities. The market sort of recovered a little bit through 2010, but then in 2011, you might remember the PIGS, which was the acronym for the European countries that looked like they were going broke. So it was a European sovereign debt crisis. So there was buying to be done then. But then you really had to wait till the end of 2018. There was a little bit, not great. But then you got finally a bit of relief. We're value investors after all. In 2000, I think it was late 2019 or maybe early 20, when the market fell very fast. from COVID and all those fears. And obviously this fund wasn't around then, but in our Australian funds, which are struggling in this current environment because we're value investors, and the banks are just trading at crazy valuations, as are many other businesses, particularly in the tech sector. Now, between 2019 and 2022, we outperformed by 37%. Now, not performed 37%, outperformed by 37%. So there's sort of life-changing, if you've got enough money invested, they're almost life-changing opportunities. So we really look forward to the correction. So unfortunately, I don't think Trump alone is going to cause a correction. I don't really know what's going to knock this bull market over. I see areas where there's crazy stuff like the banks. It doesn't make any sense to us on valuation grounds. But the interesting, this is my personal point of view, and Nick might differ, but where the bubble is, I just don't think it's in the most popular areas that people are looking. And like if you look at the Magnificent Seven, like they're growing earnings very fast. Google's trading at a low 20s multiple. The threat is more around its competitive moat and whether AI can supersede it rather than the valuation itself. If it just keeps on going as normal, then it's extraordinarily cheap, particularly to the similar sort of stocks in Australia. So to me, the bubble isn't in the big popular stocks, or at least not most of them. It's more in areas of the tech stock in Australia, the banks in Australia, and the second line, what I call the pretenders in the US. There's a lot of stocks that have gone up in the last 2.5 years, by many, many multiples, and they're trading at 100 plus times earnings. And I'd say there's definitely a bubble in those, but we don't own those. So if we get a chance to sell some of our businesses at good prices and buy other great businesses at just ridiculously cheap prices, bring it on.
I agree. One thing I would say about Trump is typically his main economic indicator of progress is what the stock market's doing. So he does have an eye on that for sure. Echo what Nate said. Some of the businesses in the US, that second tier, are absolutely crazy price. So one like Palantir is a $250 billion market cap. People probably have never heard of it. And you probably shouldn't have. They do, roughly $1 billion of operating cash flow, and most of that's in share-based compensation. But there's examples of that, particularly in the US. More and more examples every day. And we're not in them. We haven't taken part in any of that. And I just look at our portfolio compared to the rest of the market. I think it's really well positioned. Even if we do get a correction, our businesses are really attractively priced.
Sometimes you wish you were on the right side of these crazy bull markets and you own some of that stuff. Not that I'd be able to sleep at night holding them, but the fact that we've actually made our returns despite not owning those stocks, and that's what I'm most happy with so far.
Yeah, it must be very difficult too. Like I know recently we had the DeepSeek in China come out, and we've had, Angus wrote a report around the AI and how that's going. Obviously, NVIDIA, we saw it drop too. So it's very difficult though. Talking about AI, there's a really good question here. And I was just going to bring it up, but I think it was talking about whether or not, your team is starting to use a bit more AI when it comes to research and to strategy. What impact will generative AI even have on your investing selection?
You want to go first, Nick?
Yeah, sure. On the investment selection, I can say it's had no impact whatsoever, and we haven't discussed it as a team. I occasionally might use one of the generative AI programs like a ChatGPT or a Gemini from Google as a bit of background research on areas, and that they can provide links. Another company that does it is Perplexity, which sort of scrapes the World Wide Web and can point in the right direction and just make the research process a bit quicker. But I would say from a portfolio management point of view or a stock selection point of view, it's had very little impact on what we do day to day so far.
I think, I've talked to a bunch of people about this because more people are using it, and it's always the case that people who aren't professional investors think, it's just become a minimum standard for research. Why aren't you including it? And the problem I have with it is there's been so much more data collected, over the last 20 years than ever before. So everybody has more data. Sometimes more data can help, but but not necessarily in the big well-known companies that we typically invest in. And the questions we want to ask, usually there's 2 or 3 things that are going to drive the outcome of a stock. And the risks that you want to know the answers to, like more data isn't necessarily going to help you. So if I just pick on MinRes, because after the result yesterday and, it's down a lot, it's probably been just about the only stock. We'll see the question on MinRes, so let's go through it. I think it's the only stock we've actually really lost any money on in this fund, and it's pretty minimal anyway, because it's a smaller position and we bought it cheaper than we did in the other funds just because of when we launched. We just had so many other stocks to pick from. But, obviously the result yesterday was not what anyone wanted to hear. And I think the thing that actually scared people the most was Chris Ellison's almost final remark that if a new chairman comes in and he says he wants to raise equity, then we're going to raise equity. And that's really the biggest fear at the moment. So now, personally, I don't actually think the company needs to, because there's a clear plan to reduce debt as Mount Onslow is ramping up, and it is ramping up. I see all this stuff in the media about, there's been 4 crashes. Well, they're not high-speed crashes for a start. And one of them was just there was a storm, and the guy parked on the wrong side of the road. He parked too far down the side of the road. So when he went to get going again, as he tried to come up the mound, the truck tipped over. So that was driver error and wasn't even at speed. So that's the big crash that's sent fear around. But otherwise, that road that's creating all the issues at the moment has done 18,000 trips so far. 18,000. and they haven't had a high-speed crash or yet. I think the other one was just around a bend that was much closer to the mine. And the other 2 weren't really even on the road, I don't think. I think they were more around the mine. So, and driver error has been to blame for all of them. Now you've got to take face value. But if we were seeing out of 18,000 trips, I think it's amazing that we haven't seen one big flip at high speed or anything, let alone multiple ones. And the downgrade of the amount of tonnes that they're going to deliver as they ramp up Mount Onslow, that the cut is relatively small. And now they're going to put asphalt on the road, and maybe they should have done that first, but they have been unlucky. But the idea of being a good manager is that you build infrastructure that can cope with the unexpected. So, that is a cost that MinRes has to bear, but it's fixable. They just got to asphalt the road. It's not complicated, and they just got to get it done. And it's going to take 5 or 6 months and a bit into next year. I think $230 million, which ordinarily would be a small amount of money. The problem is they've just got $5 billion of debt, and that's the market cap. But in addition to that, they're not like a lot of other industrial businesses that typically go and make a dumb acquisition, and then the earnings don't come through, big write-offs, and then they've got the debt still there, so they're absolutely forced to raise money. They've got no choice. Whereas MinRes isn't in that situation. There's actually a whole bunch of money of a bunch of different things I won't go through just for time, of loans that they owe to them from joint venture partners that are coming to them, nearly $1 billion. They could actually change the debt. They could push out the debt. They talked about that yesterday, how easy it is to do that. And they'll probably deal with that next year, but even though it's 2 years before the first debt is due to be repaid. But there's lots of flexibility over that. And they've actually got lots of assets to sell. There's $10 billion of assets on the balance sheet. Like, this isn't your normal company. So if they really want to just, knock, say, $2 billion of debt off the balance sheet and just calm everyone down, they can actually do that. The problem is they don't want to do that because they think they'll be okay just with Mount Onslow ramping up and can just do it naturally, with just the cash flow that's going to come from that as the year goes on and next year, without having to sell anything. But, they might be forced to, but maybe it ends up being a hybrid. Maybe they find $1 billion of lithium assets to sell, for example, or something like that, and then they raise $1 billion, and that puts the fears in the balance sheet away, even though it's dilutive. Because I can see what's going to happen here is the company's going to get through this really tough space at the moment, and because it's it hasn't failed to deliver. Like, the reason MinRes is such a great company is because of what it's delivered in the past. Technically it's an amazing company, what it's achieved. So what I expect might happen is they'll end up raising $1 billion or maybe a bit more at $20, and then in 18 months they'll be going, we've got all this cash, we're going to buy back the shares at $40. It's just I just don't want to see that. I'd be much happier if they sold off some of the lithium assets, but I know they're not as easy to sell as necessarily what the Albemarle takeover looks like. So that's the update on MinRes. What was the original point that I was talking about MinRes? Do you remember?
AI in the, I think.
Oh, sorry, yeah, that's right. So using AI, so like the questions I want answered about MinRes is it going to get to 35 million tonnes in September? Is the road going to be fine? Are there going to be cyclones next year? Are the transshippers 4 and 5 going to be no problem like transshippers 1, 2 and 3 have been? And then they're going to deleverage and they're going to avoid a capital raising. And in 12 months' time, we're going to be looking at a $50 or $60 share price and wonder what all the fuss was about. Now, AI unfortunately can't tell me that. So, but those are the questions that really investment cases come down to, and AI is not helpful in doing that. AI is much more helpful on just trying to, in my mind, at least the way I put it is just on a statistical basis based on history, it can give you potential outcomes, but that's not very helpful here.
I think that's a very good point, isn't it? That's the thing about markets. They're living and breathing, and that's something that AI can give you some kind of idea about what to watch out for, what's happened in the past. But there's always something new, isn't there, coming in? And we've talked about Trump already. We've talked about the, obviously, environment, the, hurricane, cyclones, everything. That's what makes it a bit more exciting, at least day to day for us.
It's all about valuations and competitive moats, and the main issue in the market at the moment is that stocks are going up massive. Like, the markets have changed. That's the one thing I think really has changed more recently, and Nick might have a few comments on this, but you're getting these shorter cycles now and they're more extreme. So it's completely normal for a value fund like our Australian funds at the moment to be underperforming the market at this point in the cycle. We do it every time. What's different is that I never thought in my wildest dreams or nightmares that it would be the banks that were the major problem, making our returns look crap. It's just, yes, I get, the REA groups and the Pro Medicuses, which is like a $30 billion business now. And I get all that. And that's, WiseTech's, that's fine. That's always going to be the case. But for the banks to have caused the most relative damage to our returns currently, I mean, that's, just ridiculous. But it's just what we sort of have to put up with, because, and I think the other point of that is too, the best way to take advantage of the sort of way markets are working now is to find those stocks before the market picks up the great results in the algorithms. Because in the past, something like math to me is a good example where it's really just been sitting there, even though it's essentially been telling you that the earnings are going to rise rapidly over the next couple of years, and it's just sat there. And yes, over the last sort of 6 months, 12 months, it actually has started to rise finally. But you're just not getting all of the movement in the share price that I would have expected until the results are actually in, when the algorithms jump on. But once they jump on, because they can see what they're looking for, whether it's the revenue growth or the earnings growth or dividend, whatever it is, once it actually gets a hold of that stock, it's sending it to the moon. So it's a bit different to how things previously worked. So it's sort of frustrating on one hand, but it actually hasn't changed the way we invest, which is we always want to find great stocks before the market gets a hold of them, because that's how you make many times your money on them.
There's a lot of questions about dividends as well. Tony's asking about how they're treated within the fund. And also there's another question here just from Henry asking what income's being distributed, if any, and at what percentage rate. I was just going to also stress that if you do take up this offer, or if you already do hold this stock through your share broker or some other method, double check your distribution or dividend reinvestment in the share registry. The share registry's changed its name from Link Market Services to MUFG. So if you go to their website, it's still the same credentials to log in. You can do it through your broker sometimes, but just check to see if the dividend reinvestment is switched on. Obviously, if it's switched on, dividends that get paid out or distributions get reinvested back into this holding. But who wanted to have a crack at answering the dividend question?
Look, I would never buy this fund for dividends, and I think most people know that. If you want big, fully franked dividends, I was about to say the ASX, but they're not big anymore. The market's only yielding 3%, amazingly. Normally it's about 5 or 6% when the banks are more normal, and obviously the iron ore price has come down, so that's cut the dividends for the ASX iron ore majors. So the franking credits are really valuable to some people, so don't buy the fund for that reason here. What we really want here is the best businesses over time are the ones that can reinvest their profits to grow and become much bigger and safer and more competitive businesses over time. And CME is a perfect example of that, even though you're actually getting quite a nice dividend at the moment. So obviously we do pay them out, but they don't come fully franked. We have MAF in there, for example, which does pay excellent fully franked dividends, but it's a small component of the fund.
Yeah, and just to add to that, a lot of our businesses overseas, they won't pay dividends, or dividends will be quite small, and instead they'll actually do buybacks. So that'll actually include the or increase the capital gain, but you won't get that income return. So it's a slight difference.
There's another question here that Mitch has answered in a lot of detail, which is really good. And I know, Nick, that you're an expert on this performance fee because you proved it earlier before. But the fees for this fund and all the funds are 0.97% per annum. And the IISV has the performance fee. And Nathan, I know that you went to great lengths to explain how if you're getting charged a performance fee, it's actually quite hard to beat the watermark, the benchmark. But if you're getting charged that fee, it actually means that it's performing. I'll put Mitchell's response. It's quite large, but did you want to have a crack at it, Nathan, and see how? Nick, and see how you go with answering it?
Yeah, sure.
Sorry, coming at the pace there.
No, that's okay. Mitch has answered it quite well there. Essentially, we can only charge a performance fee if we beat our benchmark and also exceed the RBA cash rate. So it's a quite high watermark. Again, our benchmark's ASX 200 index. So we've tried to set the bar as high as possible, and you won't be worried about it if you're paying a performance fee because your performance will be stellar. So it's a 15% fee on any outperformance over those over the benchmark or the RBA cash rate, whatever's higher.
Yeah, the key thing I think for most people who may not be familiar with them or just don't like the sound of them is that I think the performance fees, and there are some shockers out there, absolutely, but they just they set artificially low performance hurdles for the hedge funds out there setting using the RBA cash rate. I mean, more power to them. But the main thing, the most important thing with our fee is that there's a high watermark and it's backstopped by the RBA cash rate. So basically that means you're not paying performance fees when, let's say, the market goes down 30% and we're only down 20%, you're not paying a performance fee. We've actually got to get the returns back above where we were before. So you're only sort of paying performance fee on the compound gains, if you like, and that's the most important thing behind the performance fee.
I was just going to say there too that obviously, as part of this secondary offer, you're more than welcome to reach out to us and ask us questions. You can email info@intelligentinvestor.com.au, phone us. You can even book a call and speak to one of us about this offer, and we'll answer more questions. And we've gone through so many as usual. There's always little questions that come up on the side. Even Kirsten's just asking, do you use the AI to digest and synthesize all the company reports that come in?
I'll just say quickly, I don't use it for that purpose, but I actually have noticed on, so we use, what's our software platform, Nick? Capital IQ. A nifty little thing I've seen in there lately is we often read the transcripts rather than, particularly with international stuff when it happens overnight. There's now some neat summaries getting put at the top, and I've actually noticed that's sort of helpful if you've got a day where you've got 5, results or maybe more. You wake up to 5 results overseas, and then you've got 5 in Australia. You just want to get through very quickly, at least just find out, whether it's a decent result or not, just the basics. They're actually going through and sort of pulling out the key bits and summarising at the top. So, I found that quite useful. It's not necessarily help me with the research, but just in terms of digesting things to move quickly and so I can focus my time on what's most important. That is a time saver.
Well, look, we've reached the end of the webinar as well, where we've managed to finish it on time, which is fantastic. That being said, what we'll do is we'll get the webinar uploaded to the YouTube channel, and we'll also put it on the website, and we'll also attach the slides, because there are actually a few more slides after this that go through more companies in detail. But it doesn't end there. If you do have questions, you can even go to the website, and there's a live chat feature where you can ask questions that maybe your question hasn't been answered today, or you've just thought about it when you're watching this on the YouTube channel after. Definitely subscribe to YouTube and also many of the social media that we've got. That way you can keep up to date with what's happening. But Nathan and Nick, thank you so much for joining us, and thank you everyone that's joined us live to watch. It's been a very interactive session, and hopefully we've answered as many questions as we can. But thanks, Nathan and Nick.
Thanks, Tom. Thanks, Nick, and thanks everyone. And just to reiterate what Tom said, I've actually included a bunch of slides sort of after the official end of this presentation. You can look at it. They're just company slides we've used in the past, and it just shows you hopefully a bit of consistency between our holdings and a slight update as to where they're trading at. And hopefully you should see that there's not really much turnover in the fund, which is what we're aiming for. You know, it's what we've always been aiming for with this fund, is buy right the first time, and the rest should take care of itself. So thanks again, and if you do have any questions, by all means, send them in.
Yeah. Thanks, everyone. We appreciate your support.